wanted to talk about our strategy and how we've been executing along the path of a low carbon transition, because I know that there have been a lot of concerns and questions on this aspect, not the least that have been centering around divestment issues as well. So maybe just as a starting point, I'll start by just defining broadly what is sustainable investing at Calstrs. Number one, it's rooted in that our investments need to deliver strong financial performance, and I think that's goes without saying. The second piece is then sustainability solutions, and so that piece we've been defining as investments that can create demonstrable positive environmental, social, and governance outcomes which support a sustainable global economy. And one question here to ask yourself is, why is this important? And I think the way that philosophically we look at it is that Calstrs is a long-term investor, right? We've been in operations over 100 years, and a sustainable future is critical to you, our beneficiaries, that are going to span multiple generations. And so we have to have this super long-term viewpoint. And the market doesn't oftentimes have that, as we know. So we need a sustainable future for the world, for business, for markets, for companies, and for society as a whole, for us to succeed in this environment holistically. In other words, to find great investments, the environment itself has to be on a solid framework and footing. So this is an area, I know we focus on climate change a lot, but this is an area that's fairly broad for us. We focus on 5 different areas. There are more focuses than that, but in terms of priorities, urbanization, things like smart cities, transport, housing, population growth, as the world might get to 11 billion in people by 2100. What's the demand going to be for resources like food, energy, water, land? How is the world going to deal with that? Income equality, which certainly is a big issue in this country as well as a lot of the developed nations. For education, health care, financial inclusion, all of those issues. Diversity, equity, inclusion is also another priority for us. And finally, climate change, low carbon alternatives, clean energy, the efficiency of agriculture, et cetera. So those are our areas of focus. I just wanted to make sure that you understood that it's a fairly broad focus for us to think about how do we, as a very long-term investor, seek to create a sustainable environment around our investments, because certainly that's going to, that strong foundation is necessary for us. I'm going to focus a little bit more here on climate change and start to narrow that funnel a little bit so you understand the pillars of how we approach this low carbon transition. I mean, to me, it just starts with a simple question of what do we need for the world to achieve a degree of warming that avoids negative consequences of that, potential global warming. And I think there are many studies and there's been a lot of consensus around net zero carbon emissions in many of the countries, as well as at a corporate level, and entities even like Calstrs considering how do we get to that point. And I think as a frame of reference, you all probably know this, but the way that we view it as well is that it's a holistic problem. In other words, if I look at the emissions issue, 96% of those emissions are already in the air. And 4% of that is, roughly speaking, is what we are creating today in terms of things like fossil fuels or agriculture, et cetera. And what I'm trying to say, the point I'm just trying to make there, without getting too complex or parsing the numbers too much, is that the development of technologies to take out emissions from the air is just as important, or even more important, than focusing on our existing carbon activities. And so we need to look at it from very much a holistic approach. The approach that Calstrs is taking is centered around this idea of of how do we get the world to the point of net zero carbon emissions to the degree that we're meeting the standards to make sure that the globe is not warming and suffering the negative consequences. So there are really three pillars here that we are seeking to transform Calstrs' portfolio. Number one is evaluate the risks that we have currently in our portfolio in transitioning to this low carbon economy. Number two is investing in climate related solutions. And number three is to expand and really focus on our stewardship activities. And there's a lot to say probably in all three of these verticals. So I'm just going to try to scratch the surface, if you will, on these three pillars and how we're approaching the situation. And then I'll go back and maybe talk a little bit about divestments, because that hasn't been a focal point of our strategy, but just to talk a little bit to it in terms of, because it is something that we also continuously evaluate. It is a tool, so to speak, in the toolkit, but we've chosen to really focus on a different holistic strategy at this point in time. So starting with evaluating the risk for transition readiness, I would say that probably, over the last decade, there's really been a lot of scientific study on the physical risks of climate change. And it probably goes back even further than the last decade, but I think over the last decade, this scientific evidence is no longer in question. And there's been some consensus around how we will be experiencing these physical risks. And so now that there is consensus around the science, what we've been doing is working with some of the folks who are on the vanguard of assessing the physical risks and translating those physical risks into an emerging area, a new area of research, which is how that's going to affect physical assets. So for us, if you can think about our real estate portfolio, there are areas where if global warming takes place and continues to take place, we know that with some degree of certainty that even if we were to make the changes that we hope the world is going to make, that some of the areas of real estate are going to be underwater. And so how do we map that future to our current portfolio? Those are areas of new examination, and we've been trying to map that across our total portfolio. Not only I gave real estate because I think it's easy to understand from a physical perspective, but the same could be said of our fixed income portfolio or global equity portfolio. Those over the last couple of years have really been our focal point. That's 75% of our portfolio roughly, and we've been mapping those physical risks and the changes in the environment and how that's going to affect our portfolio. And what I can say is that it's a very interesting level of research because the risks don't seem to be embedded in the future. In other words, there seems to be some inefficiency or disconnect between the existing science and the ability to map that into things like your physical buildings and how they are trading in terms of their valuations and asset prices. In other words, we don't see a lot of difference yet between those areas. And so certainly one very large pillar for us is to evaluate these risks, to continue to think about decarbonizing the portfolio from that aspect and to move in that direction. Another element, and we've talked a little bit about this before, is investing in climate-related solutions. And we have been on a path to do that. I think this slide shows you sort of the existing scope of the areas that we've been investing in. We have $7.8 billion, for example, in low carbon public equity index-like strategies. We have 350 million or so in green bonds, 500 million in inflation sensitive. That's really infrastructure invested in things like solar, wind, and other renewable power. Private equity, we have invested in clean energy portfolios. It's similar to what we do in inflation sensitive and infrastructure, thinking about that, except that it's a bit higher returning, higher risk. That's the difference between the two portfolios. And then real estate, where we directly control our buildings and have been seeking to create buildings that are environmentally friendly. So nearly 90% of our Calstrs directly owned real estate falls within that bucket. But we're not stopping here. We've recently done we've recently launched a new initiative across the private assets. And that's really to pair up our SIS team with the rest of our organization, particularly in the private assets, and create a more systematic approach to find and select investments across the landscape of our asset managers. It's a new initiative. I think that we've been looking at a couple $2 billion of investments across our pipeline of private equity, real estate, infrastructure-like investments. So I think this is going to be a great initiative for us to continue to move the investment needle. And I think there's going to be more to come from that perspective. It's really timely now to talk about our sustainability and stewardship at Calstrs. We look at it from 3 vantage points, and this is the third pillar, of course. The first, think about it from a risk management, risk mitigation. Secondly, investing, and third, how do we engage with companies? Because we believe that we're going to provide a significant influence to the industry to move in the right directions, to develop and invest in the technologies that are needed in order to get us to the right point of a sustainable future around climate change. 3 areas that we focus on from the perspective of engagement. One is proxy voting, being able to use our voice in voting on initiatives. The second is just engaging directly with companies. I'll talk a little bit and maybe give you an update on our direct engagement with Exxon, which today, actually a historic day to talk about it, because today they had their annual meeting. And the third is advocating from a policy perspective. So from a company engagement perspective, I think that a lot of you already know that we're part of a number of initiatives. One of the prevalent ones is the Climate Action 100, which is taking a number of our peers, including Calstrs. We've led probably 4 of the 8 or so initiatives. And I'm happy to say that for those 4, Southern Company, Duke Energy, Dominion, Daikin, they have all agreed to go to a net zero framework. And so being out there and teaming up with roughly, call it 3 trillion or more in capital together, we're exerting a lot of influence in engaging directly with these companies to move forward. One of the companies that wouldn't return our phone call, frankly, was Exxon. And so we've decided to engage with them even more directly. And it's one that was grounded in being one of the worst performing energy companies. And we looked at their strategy. We looked at their investments, and we just saw a poor allocation of capital. In other words, they were continuing to invest a very high amount of capital, or CapEx, into what we thought were marginal investments in the oil and gas industry that necessitated a high oil or gas price in order to even make them profitable. So here was an organization where they had a strategy that they had been performing relatively poorly along those lines. We began to engage with them, and they wouldn't listen to us. So essentially, we decided to go the next step, which for us was to try to bring change at the board level, to actually say, hey, we're going to propose an alternative slate of directors. And as we looked at their director slate, they didn't have deep expertise in areas such as renewables or energy transition. And so we thought this change really needed to come from the top. And we, so far, I think number one, the first thing they did was reduce their CapEx to these high oil and gas sort of marginal projects very significantly. And the second thing that I think is coming to head today is a vote on that alternative slate of directors. Today, I think, is a historic, it's truly a historic moment. You turn on CNBC, Bloomberg, you're very likely to see news on this engagement today because of the annual vote. And what I can say is it seems clear that 2 out of the 4 directors that we had been proposing along a small organization called Engine Number 1 have been elected, and 1 appears to be sort of on the bubble. We think that that news might come out over the next 1 or 2 or 3 weeks, but the vote has been too close to call that 3rd director. I mean, if you had asked me going into this, would that have happened? No, that's why I think it's really truly a historic moment where a company, a major oil and gas company, is facing a dramatic change at the board level. The other thing that I think goes along with this is that as we had been proposing as Engine 1 has been proposing a different alternative director slate, and we've supported that slate. There have been, Exxon also has decided to bring a change to their board as well, and proposed a number of new directors, of which two of their directors we support as well. I think that 2 of their directors will be also elected to the board. So that right there, if we think about 2, maybe 3 of the alternative slate of directors that we wanted getting onto the board, and maybe 2 out of the 3 or 4 that Exxon had proposed, that's a lot of change at the board level. And I think, again, that's just, it's one of those historic moments where we didn't know how this would turn out as we started to engage them and really seek to take it to the next level in changing their board structure. But, I announced some of those results that were coming out of the news of this meeting today. But if you looked at it, not only Calstrs, but CalPERS, New York State Common, a significant number of asset owners also were backing change. But we also had some of the largest asset managers, BlackRock, Vanguard, Legal & General, State Street, and 2 of the most prevalent proxy voting firms, Glass Lewis and ISS, all kind of moving in unison to say, you need to change your board structure. You need to start moving in this direction of a transition to a low carbon economy. So anyways, I'll stop there with the company engagement, but I wanted to give you a little bit of an update because today I think was really a shift and a historic moment in this level of engagement that we've seen. I'm not going to go too much into the sort of the second and third prong, but we as I was saying before, we vote our proxies and are very diligent in trying to seek change on a number of issues, not only climate change, but I'd say the big 3 are climate change, pay, and governance, including things like diversity and inclusion. And finally, we also partner with global regulators and our peers to promote policies and practices that we think are going to create long-term value. So we've been very involved on a climate change basis on measuring and reporting and getting to the point where we can bring that to corporations where they're going to need to report on and measure on issues. So that, I just wanted to give you an understanding of how this is a very complex issue. It's something where we've developed, we think, a very holistic approach to deal with something that is a very sort of complex issue. But on the other end, I do want to just talk briefly on divestment, because that's something that we get asked about a lot. It's not something that we've really wanted to lead with relative to our strategy, because we think that the holistic strategy that we've developed is going to be more effective in moving the needle. But in terms of divestment, why hasn't it been something that's a lead strategy for us? I'd say there's probably three reasons. The first is, we talked a lot about how on an investment basis we want to have our portfolio very diversified to weather the different crises, the storms, and to perform in different environments. We're a very large asset manager, so we tend to own almost everything. And when we don't, we can be less diversified. And that really just speaks to the fact that there could be more risk for us when we're less diversified. When we divest from, for example, in the past we've divested from tobacco, and there's really no way for us to know at what time tobacco is going to become a better or worse investment. So it is a tool in the toolkit, but we don't know where that ball is going to bounce over time. We would have to really engage in active management in order to manage this risk. And if I were to look back at the history of divestments, this could have bounced either way, but it has ended up costing us roughly $8 billion in performance as of the last quarter of record, April. So cumulatively, the sort of the ball has bounced in a way that had us lose quite a bit of performance. But I think that conceptually, the way you can think about it is that when we're less diversified, we take on more risk. When we take on more risk, it becomes more difficult for us to long-term meet the 7% hurdle in order to generate the types of returns. The other areas is as we think about engaging and owning companies and engaging them and trying to influence them versus divesting from them. I mean, one could argue that if you divest from them, you send them that one-time message and the industry gets it, and maybe that is the best influence you have. Another might say that, no, if we own the company, we have a voice, and essentially we're going to not only use our voice, but we're going to team up with the voices of others, similar to the concept of what I've talked about at Exxon. There are a chorus of voices here trying to influence change. And I think that we've been focused on that approach because we do believe that we can be successful in influencing organizations. But there's another, I think, relevant and compelling issue, which is that if we think about the problem holistically, we're going to need to develop the types of technologies that not only are going to reduce our current emissions, but also be able to take it out of the air, because most of the problem actually already in the atmosphere. And so how do we encourage companies to do that? A lot of these companies that we're engaging, they have it's not to say that they're going to be the only ones that develop these types of technologies, but we have the hope that they have the technical expertise, the personnel, the existing infrastructure, and the scale that would really support these types of technologies in the development of them. And so, I think that reasonable minds can differ in terms of, should you be influencing the company? Should you be divesting? Which is the louder voice? We think that to us, we need them we need to influence them. We need them to be part of this solution. We need them to develop technologies, and they have the scale to do it and support it. And so, we continue to try to do that. And I think we've been fairly successful. If you looked at the track record with the Climate 100, as well as even with Exxon sort of moving the needle after starting from a position where, frankly, they didn't even pick up our phone. So the other question then is a question of, well, if we divested from fossil fuel companies, number one, we would be taking on a lot more risk. We don't know whether that risk would be to the upside or to the downside, but when you take on more risk, one thing is for sure, your probability of succeeding is going to go down. But on the other end, would divestment, would that be a better strategy than for us to actually engage with companies? And I think that, another thing for us to consider is that the fossil fuel companies, the majors that we end up engaging with, they tend to be leading. And so, for them to help change the landscape would be a great thing. But the other end of it is that they're very much a very small part of the whole equation. In other words, when we talk about divesting, the majority of the world's oil supply is not coming from these corporations, even though those corporations tend to lead the industry in terms of the direction and technology, which we hope to influence them to do. But it's really the larger state-owned enterprises in countries that are responsible for the major oil supply. And so what would be the consequences of even, sort of trying to diminish this one group if it just makes the larger group, the one that we can't control but only influence, makes them even sort of more powerful, if you will, alongside this. And so the question is would divestment, even though we would take on a lot more risk to do that, would that even sort of move the needle with the majority of the world's oil supply that's coming from big oil that is owned by state-owned enterprises, or should we stay in this, own the companies and really seek to influence them, and hopefully that not only changes them, but it changes the landscape of how the larger part of the world's oil supply does business as well. So anyways, I'm not sure if I illuminated or provided more confusion along those lines, but I just hoped to engage you in a dialogue that, this is our approach. This is what we think is a holistic approach to really dealing with what is a significantly complex issue, the issue of climate change. So maybe I'll pause there. I think there's probably going to be a lot of thoughts around that last segment. Let's see if there are questions.
Can I ask a question too, Scott? This is
Jennifer. Sure.
Because I'll turn my video on, that way you can see a live person. There are at least around 10 different issues right now that different organizations or groups are asking you to divest in. And each group contends that it won't cost any money. So, if is that correct? Is that perception correct? And and I understand what you're talking about when you say your strategy is to, it sounds like what you're really trying to say is you're trying to change behavior. If Calstrs and CalPERS and other similar types of pension funds were not engaging, would that likely help or hinder the change that you're trying to affect? Would be the two questions that I would ask.
Yeah, so to the first question, is a very difficult one to answer in finite terms, because essentially what would happen is we would take on more risk. We would be less diversified. And then the question would be, well, how would the portfolio perform outside of those investments? And inevitably, with the most probability, if the risk goes up, essentially what it means over the long term is that it's going to become harder for us to reach the goals we need to secure the retirement of our teachers. It's simply that. And I wish there was a way to quantify it, but it's a matter of probabilities really shifting in the wrong direction. And so if you were to ask me what the cost would be, the cost for me would be, I would say it would be hard for me to quantify the risk of us not meeting our expectations to the degree that we don't secure the retirement future, right? That's a huge risk. And I can't quantify that because it's large and would depend on probabilities that we don't know what the future is going to hold. What I can say is, even in the smaller amounts of divestments we've done in the past, like I said, the probability could have been, the probability again is that we were taking more risk in having a less diversified portfolio. That I can quantify the past in saying that has cost us $8 billion to our performance, which is it's a very significant number. The number that would be assigned to fossil fuels would most likely be well north of that in terms of its effect. So it's hard for me to answer that question directly because it deals with risk and probabilities, of which I don't think anybody has a crystal ball of the future. But I can say definitively that it would be something that would really worry me, because we'd be taking on more risk, and I don't know what the outcome would be and whether or not we could make our goals and objectives financially. So that would be that would be something that it's not something that we don't debate internally, because obviously divestment is a investment response. It's something that we could decide. It's just that we believe that it would just cost so much risk that is it something that we would want to move forward with doing? I would say no. It's a lot of risk in order to do that. And the second question, Jennifer, could you repeat that quickly?
If you were not investing, if you were not engaging the way you are, would there be organizations that would be doing that engagement, or would the push to get corporations to change their behavior, would that cease, or would it continue? Would it be stronger?
Yeah, we believe that we're on the forefront of the voices engaging organizations, and if you looked at Exxon and the engagement that's currently going there, we basically started that engagement with engine number one, and we didn't know how far this was going to get. Now, frankly, I think in retrospect, had I known that it was going to get so much traction in terms of the initial shift that we would seek, which is to change the board, to then change the management, to change the strategic direction of the organization, then it would have been very clear that up front. But to see it now, it's I think really a monumental event. It's historic. And had we not been invested in the organization, we would not be able to do that. So whether others would step up in our place and look to seek to influence engaged organizations or not, and what the effect of that will be over time. Now, we believe that again, in the sustainable future that we're hoping everyone is moving towards, to the degree that it creates the right global framework, we really do need these organizations not only to decarbonize their portfolios, but they have to go down a path of also developing the right technologies to not, so it's not only a matter of what they're producing today and hopefully decarbonizing that, but it's also developing the types of technologies that are going to decarbonize the what's existing, which is the bulk of the problem. And I think not a lot of folks are focused in on, which is that the bulk of the emissions is already in the air. And how do we extract that out, as well as being able to create the right transition? So we think that, clearly, engagement is the way to move folks towards that arena. If you don't engage them on that pathway and that development, I mean, I might be cynical in thinking this way, but I don't think they would do that. I think they would just rather keep going along their I mean, take Exxon, for example. If we didn't start engaging them, they wouldn't even call you back. I mean, they literally, so I don't want to overplay the hand of engagement, because I think that there is a hand in divestment in making that a consideration as well. It's just that it's, I believe, and the investment team believes, that it's very important to influence these organizations. Otherwise, I find it hard to fathom that we're going to develop the right technologies. We're going to get them to move more quickly. And I've been surprised over the last couple of years that more and more corporations are starting to adopt this viewpoint of a net zero emissions framework and moving their organizations towards that target.
Thank you, Scott. The only other question that I can see, now I have to find it again, is, let's see, it was from one of our, now I'm Michael. What is the RMS category in the investment pie?
Great, thanks for the question. So RMS stands for Risk Mitigating Strategies. And you can think of this as essentially being an asset class that is designed to perform well when the markets are going in the opposite direction. So, for example, if there's a crisis, or if there's a recession, if there's a depressionary level event, the RMS portfolio has been designed to provide an offset to that. And we certainly saw that it was one of the best performing assets during the crisis of the pandemic, along with our fixed income portfolio. So you can imagine that at one point, fixed income, after a 30+ year decline in interest rates over time, fixed income used to, for a lot of institutional portfolios, used to really focus on providing that, what we call an anchor to windward, or a portfolio that was designed to do better when everything else was doing poorly. Because of that bull run in fixed income over the 30+ years, that role has been sort of diminished from fixed income. And we created RMS probably 3 or 4 years ago. I'd say, 3 or 4 years ago, in order to help serve that role. But it includes things like CTAs. It includes things like long duration treasuries. And it includes other managers like global macro. These strategies tend to focus on areas that would provide that that better performance as things are going down. So that's.
Can I add to that? Because I actually remember when the board was having the discussion, and it really was a reaction to the Great Recession. And so when the Great Recession hit, we had at the time been trying to get the legislature to work with us to put together the full funding package, which ultimately became AB 1469. But we had all started working on that back after the dot-com bust in 2003. And there was also a realization that Calstrs was somewhat more vulnerable because you can't change rates the way CalPERS does. So you had to try to be more creative in other areas. And this was one of the creative ways that the board had felt the investments team can try to soften the blow if there was another downturn similar to the either the dot-com bust or the Great Recession, that it would help the fall to not be so dramatic, to try to protect Calstrs. It was a part of it was a function of the investments, but part of it was also a realization by the board that they had to try to be more strategic, but it's been an ongoing conversation they've been having for a few years.
Thanks for that color.
Thank you. And thank you, Scott. We need to move on to Joycelyn, but you are always so informative, and I do want to remind people we are really fortunate that Calstrs is always accessible and ready to explain things. So we need to be respectful in that manner, as we always expected our students to. We need to also go that route. If you have specific questions that we have not been able to answer, I am going to save the chat and I will get back to our next speaker. That's right, it's Jennifer.
And Jennifer. I know, yes,
it's Joycelyn.
Joycelyn.
Yes. Did I say the wrong one? I'm trying to save chat so I can make sure I can get all these answered.
Joycelyn Martinez-Wade from the Government Division at Calstrs. And so I'll provide a few updates on legislation. And so we have 3 sponsored bills this year: a housekeeping bill, our Calstrs Ira bill, and our investment procurement bill. The investment procurement bill really actually ties into what Scott started talking about near the beginning in the collaborative model. And on the administrative side, it works on procurement and how we have to go through the procurement process currently that all state agencies go through for our investment managers and advisors. And it's really quite a different environment where our staff really know, our investment experts really know the market out there and who would be best to work with, as opposed to if you're trying to figure out who's going to publish a certain report for you, or if you're trying to buy paper or staplers and you don't know exactly what the market is out there for that, and you get the best bids that come in. So I'm really excited that that bill has been moving through very smoothly. It's an assembly bill now on the Senate side. Our housekeeping bill is a Senate bill on the assembly side, so they're right where they're supposed to be in the process. Our Calstrs Ira, which will provide a traditional IRA as an investment option on the defined contribution side, so there are more savings options for our members and retirees, and actually anyone who works at a school. So if you know other folks who work at schools, our Pension 2 program is open to them. But that bill is on the assembly floor, so again, with probably hundreds, if not thousands of other bills on the assembly floor waiting to go to the Senate. So we're looking forward to when that vote can come up. We have 4 bills going to our board for position in June. And that, I believe it'll be on June 9th. So I'm up the first day with the action items and just want to go through those briefly. But there's AB 845, which is a rebuttable presumption that illness when you related to COVID-19 was an on-the-job illness. So this actually doesn't affect us much. So our recommendation will likely be neutral because our disability benefits are not based on an on-the-job illness or injury. That doesn't matter except for an exception if you're not to the 5 years you need of service credit to be able to get a disability benefit. But that bill is out there and the board will get to hear about it. There's a bill requiring an emerging manager and diverse manager report. We've continued emerging manager report since 2012. I think the statute was originally initiated. So we have a report very similar to what's being requested in AB 890. And so we've taken a look at that and we'll be presenting that to the board in June. There's also AJR 9, which I know you are sponsoring. So that's the resolution that supports the repeal of the WEP and the GPO. Our board has already taken a support position on the federal bill that takes those actions. So recommendation is support for AJR 9. Thank you for that. And then we actually do have another federal bill. There's two of them, the Senate bill and the House resolution. So S588 HR 1549. In the Senate, it's authored by Senator Feinstein, and this has to do with the Climate Risk Advisory Committee on the Financial Stability Oversight Council, and basically including climate risk as a factor in many different venues at the federal level for regulatory agencies, amongst other provisions. So those are the four going to the board in a couple weeks. It seems so far yet so close that board meeting is coming up. And then actually connected mostly to what Scott talked about today, I'm gonna let you know about SB 457, which I'm sure you've heard about. I know Jennifer has been super active on this bill, and also AB 1019. So these are Turkish divestment bills. And so I know that was crucial to AB 1019 not being heard, that this group was making calls and your colleagues were making calls to the assembly members. So thank you for that. It was sort of a redundant measure with an Assemblymember Zarian bill from a couple of years ago. But as Scott talked about, any type of lack of diversification adds to the risk of the portfolio. So we really didn't want to see that bill move forward. And SB 457 actually is a whole different animal, although it's being portrayed as a similar animal to that kind of divestment bill, because this bill actually allows individual districts to choose portfolios that exclude Turkish investments in this case. It is a very vague bill. I don't know how they're defining that. Again, just one sentence for Calstrs, one sentence for CalPERS. They allow these choices at districts where they are not fiduciaries, don't have investment experts working for them like Scott, who know the marketplace and how to make decisions when there are these risks involved, yet we still have to produce returns to be able to pay benefits. And so it's super concerning. Because it's such a different approach, we don't have separate portfolios for separate districts right now. We don't allow individual choices as to what people want to invest in, because we're a multi-employer plan, we are a risk-sharing plan, and that allows us to diversify, again, as Scott talked about. So some of the biggest benefits of that are that we can be in private equity and real estate. And if you have a smaller portfolio, if there's a number of districts that would choose a different portfolio, you wouldn't be able to invest in those, which are some of our highest earning asset classes. And then it makes reaching that 7% that we talked about earlier even that much more difficult. And in the end, if we're not getting those returns because of these changes in the bill, then you might be looking at higher state and employer contribution rates. Again, hard to quantify exactly what the result would be, as Scott explained, but that would be a tremendous undermining of the funding plan, our benefit structure, and our investment portfolio. So SB 457 is really scary, and it is unfortunate that it has moved through the Senate and made it to the Assembly. So we'll be working hard to hopefully have the bill not heard in committee like AB 1019 wasn't, or having it voted down. So I wanted to make sure to touch on that as well. And that's all I have on legislation, so I can take questions if anyone has any.
Let's see. What's the ultimate timeline for SB 457?
I might be able to help out, and Joycelyn and I have been working very closely on this issue. This is a 2-year legislative session. So since that bill has now moved from one house to the other, so it unfortunately passed out off of the Senate floor on Monday. And so that bill has now moved to the Assembly. So our goal, as many of you may have seen the legislative alert that was sent out this morning, is to try to keep it from getting a hearing in the Assembly Public Employment and Retirement Committee. That would be the best case scenario. That said, it could then still move next year, potentially. And so it's not over until it's over. Senator Portantino is chair of the Senate Appropriations Committee. And so it makes these conversations very sensitive. And what's particularly, I'm trying to be diplomatic, and what's particularly disappointing and frankly frustrating is the fact that the Senate Labor Public Employment Committee passed that bill with a condition that Senator Portantino work with the opposition to address our concerns about the negative fiscal impact to Calstrs. Senator Portantino was unwilling to work or collaborate with us, and despite that, they still moved it forward. So we're hoping that we're putting a lot more of our eggs in on the assembly side, because they have been better when it comes to understanding how this can impact Calstrs. But of all of the bills that I've seen, this is the most dangerous, because it could have the potential to eliminate defined benefit as we know it in California. And there have been a number of states that have recently eliminated their defined benefit programs already. And there are a number of state legislatures that currently have bills that would eliminate their defined benefit program. So we're not safe per se, as long as these conversations are taking place. It's part of a much broader threat. But ultimately, our timeline is make sure SB 457 doesn't get heard before the end of this year legislative session, and the legislative session ends in early September.
Thank you, Jennifer and Joycelyn. And on that, I will note that we are now moving on our Wednesday. We always save our Wednesdays for state issues. So you will be seeing that alert going out every Wednesday until we are sure that this doesn't continue to move forward, because it is a very dangerous situation. And we're going to go over that more during the general discussions. Is there anything else that Scott or Joycelyn or Diane, I see your name and nothing, no picture, that you'd like to add?
Well, I didn't, I was just going to say, I would like to address some of the questions in the chat if there's time, because I didn't see them as I was talking, but I do see them now. But
it's always hard to see when you're talking.
Yeah, I couldn't see these questions come up, but I think other people might have more questions. We can reserve it towards the end, but I think that there are some questions here that are very interesting to answer, I think.
Yes, there was one about the responsible weapons and arms that somebody else asked, but I had the same question, Mr. Chan. I'd appreciate if you could address that. That was that fourth category there about responsible arms or responsible weapons.
Okay, and what was was there a specific question or just?
No, it's just.
I think, Scott, it was just more curiosity, what that was, just dive a little bit deeper into the responsible firearms and some of the role that Calstrs is playing in that from a priority point of view.
Yeah, it's one of the parts of an engagement, again, that we're engaging industry organizations and corporations. Really, the focus has been on safety. And so we've been trying to engage folks to focus on, for example, how does one qualify, for the right to as it goes from the retailer to the consumer of a firearm. So what information might they need to provide as to make the environment more safe? Are they checking on the individual as an example? But our engagement is really focused on those safety elements. There was also, I think Charna had asked, if I'm pronouncing that name correctly, had asked a number of questions around the potential for our sustainable investments. Is that?
Thank you. You said it correctly. I want to know, are we making political decisions? Are we making financially responsible decisions? Are we a political organization, or are we investing in our future? And it concerns me that we're being targeted for our money to make investments in somebody's idea. And I'm very fiscally responsible. I think we need to make the money, and we need to go where the money is. So I hear you talking about this Green New Deal, and I remember Solyndra. So my pointed question is, what's our role here, and how are we going to protect the money? Because that's all I have my eyes on. Thank you.
Yeah. Well, I appreciate that question, because that's exactly what I think about all the time. And I do think that this area has had a checkered past in regards to investing in a low carbon transition, particularly when it comes to new technologies. So our focus as we thought about this was not to avoid those new technologies and new areas where we cannot assess accurately an investment. And I did want to just emphasize that everything that we do must meet a risk and return hurdle. We don't do anything from a political standpoint. So it's either a great investment or it's not. And if it's not, we don't invest. But in thinking about our approach, we've tried to design it around how can we avoid those bad situations. And one of the more interesting elements of the industry is that the industry knows that the managers who we do business with, they know that there's a huge demand for green investing. And I think you've heard the term greenwashing. A lot of managers are creating products just so they can earn fees on this on just this huge demand and the inflection point that people are looking for these types of investments. And so our intention is to by far just avoid those types of investments. But what we've observed is that managers are doing great investments. They're just not labeling it as sustainable investments. And so, as an example, right now our team is involved in a transaction where we're looking at distributed solar. So think about Amazon wanting to create solar to provide energy for their businesses at a local level. That is a contract with a AAA corporation, which essentially would provide a 20-year contract. The rate on that today could be something like 8%. That's without financing. Financing has been extremely difficult in new areas like solar because it's a new area. So banks don't know how to finance it. But this particular project has an advantage in that they have an insurance company base that is willing to provide financing for something that actually is a great long-term rate to begin with at 8%. With a 20-year contract from AAA credits. But if you add in very low financing through insurance company vehicles, it becomes a great investment and something that is also in a sort of a physical asset form. Operationally, there's a lot of track record around the business of distributed energy and solar technology as well has come to a point where it's a technology that is not in its infancy. Let's just say that it's taken quite a bit of time to move to this point, maybe 20 years plus. So those are the types of investments that we would be making and are reviewing. But it goes without saying, and I appreciate the question because I don't want to do anything that doesn't have an appropriate risk return. And so as we were thinking about our strategy and how do we go to market, it was very important to us to even think about, well, how do we position ourselves? How do we first source the right types of opportunities? And I do think that the industry is probably looking at it in the wrong way, in the sense that all these new products that are coming to bear are likely not going to be great investments. But we do see great investments happening in the industry and with our partners, where we think we're going to earn a superior return, not only a good return on an investment, but a superior return.
Thank you, Scott. And
Thank you. Terrific. Appreciate you taking
that was a good question, Charna.
Charna is channeling my inner investor, because because this is good. I mean, I would hate to see an investment that makes no sense, and that's not what we want the team to be doing. There was a question on crypto as well, which actually is a new technology. I don't know if we want to talk about that or whether we should.
Well, if we need to wrap it up, maybe after this one, and I'll save any other ones, but I want to add on to what you just said, Scott and Charna. And I had sent her a message. We all want that secure pension, and that's why we appreciate the transparency with Calstrs, and that you are responsible investors, because we don't want you to invest in something and lose our pensions. So thank you. And then you want to do the bio company. What is crypto? That? The crypto money.
Crypto is right now. I think the lead-off sense would be is that Calstrs is not investing in cryptocurrency. That being said, it is an emerging technology. The blockchain, is an emerging technology that we are watching carefully. Like all emerging technologies, they start off promising something, but not necessarily delivering it. And I would say about blockchain that is where we are today. It's promising to be secure. It's promising to be lightning fast. It's promising to be lower cost. And it's promising to be this immutable ledger that essentially you can transact, and both sides instantly on the blockchain receive that knowledge. So as an example, if today, and you know this probably better than I know this, but if you were to do an ACH transfer from your brokerage account to your bank account, you wouldn't see that until 2 days later in your bank account. And you're kind of like crossing your fingers, like, I hope that money went and got there, right? And then you're checking it constantly to see if it got there. On the blockchain, you make that transaction, and on the ledger, it's received there. But where the technology hasn't delivered, so it's by far secure, and it's also on this ledger. But where it's fallen short is its scalability. Not that many transactions can be done. It's costly as well, and it's not fast. So as the technology matures, I think it will get to a point where it delivers on its promises. And I do believe that blockchain will likely get there. I don't know when it will, but it's something that we're watching carefully, because it could transform a lot of businesses. It could transform internet, financial services, currencies, and the way we transact. It could transform a lot of them. But I think that like all technologies, we're in that really early adoption phase, where I would say that it hasn't delivered on its promises. Once it starts to deliver on its promises, I think that then you have a framework where typically what you've seen in technologies is that something magnificent gets built. For example, the Apple iPhone. So number one, we're waiting for the technology to work effectively and deliver on its promises. But number two, then it would be about what applications really start to move the needle on cryptocurrency. There's a lot to cryptocurrency. A lot of it, I want to hold back from saying that some of it just seems completely fraudulent to me. But I think from an institutional perspective, we look at it from that perspective of the technology, its ability to work as a distributed network that's secure, fast, and cost efficient. And we're still watching and waiting. We haven't made any specific investments in this area.
Thank you, Scott. All right, I'm not going to go invest in it because I always watch what you guys are doing. Again, we want to thank all three of you so much for joining us again today, and the great questions. And hopefully, if there's any more and we haven't covered it, I will send it off to Scott. But if you want to stick around for our general GRC meeting, please do. I know you have nothing to do up there. And we look forward to seeing you at the client advisory in a couple weeks. So thank you.
Thank you very much. Take care, everyone.
Thanks, everybody. Have a great, I know it's a bit premature, but have a great Memorial Day weekend.
Yes. Yay.
Right.
It's like every day's been a weekend. But,
starting to feel that way.
Right. It does.
Bye.
Okay.
Thanks,
Bye.
everyone.
Thank you.
Thanks.
Bye-bye.
I'm going to go ahead and I have opened up. I'm going to show if you are a guest and you aren't on the Government Relations Committee. Hopefully you can see our talking points. If you can continue to stay muted, because we're so excited. We have so many people here today. I'm going to jump around a little bit because there's some things that flow better with others. But first of all, great news, HR 82, the House bill, has now 153 co-sponsors, up to 36 from California. The three from out of state were Wasserman, Schultz, Delora, and her name is Wasserman, Schultz, Delora, and Williams, are all on the Bipartisan Women's Caucus, and they were in our April through May 1st alerts. So your advocacy is working. We are going to continue on Tuesdays to have you email the California non-sponsors. We're only down to a few, and hopefully we can get some more there. Wednesdays, as I said earlier, when Calstrs was talking and Jennifer, we're going to really focus on state issues right now. The SB 457 is critical. She'll go more into that, but that will be your Wednesday alert, and it is a phone call. It's more effective to actually call. They will record your name and the fact that you did call, and it made a big difference before. We have a Senate bill that is the partner to HR 82, Senate Bill 1302, presently has 30 co-sponsors, and one of them listed is Senator Feinstein. But we leadership met with Senator Padilla's office staff last week, and already he had committed to co-sponsoring. So it's just a matter of getting it documented, and we will be having the 2 California senators on board. So that's going to be updated on the website. We are working towards both of them, but right now it's to get HR 82 up to over a couple hundred and move forward. The partial repeal of the WEP HR 2337 by Chairman Neal is at 154. Do you see my smile? I think it's very telling to see that HR 82, the bipartisan bill, is moving ahead. And so we are still putting pressure with Representative Neal. I work with a national group, and we are continuing to work on him to add the GPO. And Representative Larson is one of the key players on that right now. He's been very responsive with this group and what his promises are. So we're hoping that there will be some movement in the fall to early winter when President Biden moves forward with some Social Security reforms. He has promised that weapon GPO will be in there. So you will be seeing changes once we hear and see if something's moving that way. I'll be adding on the website by the end of next week the addresses for postcards, because a lot of our divisions are starting to schedule in-person meetings at the end of summer and for fall workshops. So those postcards need to go to the White House for President Biden and Vice President Harris, who have both promised and committed to adding the repeal. So exciting. Again, get everyone you can to act on these alerts. I'm going to go through a couple of things out of order just because I can't, no, just because I wanted to. First of all, thank all of you for the honor to be the new president-elect. And I again want to assure you, I am committed to be GRC chair for this next year until our current president, Ron, is ready to move forward. It's his appointment. And then that way I'll be able to pass off, and hopefully the new person will bring in even more exciting ideas. But I just want to make sure everybody understands I'm not going anywhere. I was so touched when I got home the other day from the committee. I've already ordered my bowl. I told David and Jennifer, I walked in the house, and I'm such a shopper. I'm like, they gave me a gift certificate to this artist studio who makes handmade pottery and bowls. And so I called this morning. So I'm so excited and I'm deeply touched. So thank you. We do have, and we'll have more, but GRC committee, please save the date. We are planning on in person in Sacramento in March. If we're not in person in March, then we're all going to be needing to make sure our provisions are lined up in the home. But it will be Advocacy Day, March 23rd. That's been approved by our president. It is going to be on the calendar. GRC will need to be there the 22nd and stay the morning of the 24th. We'll go over that more and more. But that was exciting to be able to say we're shooting for March in person, and it's Sacramento. You can just see at the bottom upcoming dates, so I don't need to go over those. So I'm going to turn it over to David and Jennifer. We're going to get a state legislative update and a budget update.
So Jennifer, why don't you start with Senate Bill 457 and then touch on a couple of the other bills, and I'll do the budget update.
Can do. I would say it's somewhat of a mixed bag for what's been happening with the legislature, but SB 457 has unfortunately not been a positive step forward. And just to add a little bit to what Joycelyn had noted on SB 457, the reason this is such a big issue is you could literally have different community colleges or different school districts deciding to divest. And once you open it up in one issue, you open it up to a number of other future issues. So I'm sure for those of you who have been to your school board meetings or community college board meetings, how much more colorful some of those could get with some of these topics, and how complicated that could get, because these decisions would not be made based on what is best fiduciarily for the fund, but it would be something that would be more of a subjective discussion. And then the question becomes, well, who pays for the costs? So if you had someone like a LAUSD say, well, we want to actually have Calstrs divest on our behalf, and they lose funds. So, you know, Scott noted they lost $8 billion cumulatively on tobacco. Well, you know, if the 1 year loss on a divestment issue for LAUSD were $1 billion, who pays for that shortfall? Is it just LAUSD? So are they going to have increased district contribution costs, or is that going to be spread out across the state? That decision has not been contemplated. So under our existing system, any additional shortfalls would be something that everyone's responsible. So that you would be looking at, increased district contributions potentially, as well as state contributions. If Calstrs had to lower their rate of return, their expected rate of return because of this to a lower rate of return, that would literally add potentially tens of billions of dollars to the current shortfall in AB 1469. And if I haven't traumatized you enough already, just to add a perspective, if something happened that significantly reduced the long-term fiscal projections for Calstrs, remember that the Teachers Retirement Board sets the rate of return for the SBMA at 7%.